this is the accounting channel brought to you by First Accounts. Today I want to talk about strategic planning, which forms the first video in my series about performance management. So let's begin. There are generally three levels to strategic planning: strategic level, the tactical level, and the operational level. From left to right, we would have these three things, which would go from board level down to executive level. Then we get to the tactical and operational levels, which would be considered upper and middle management. Broadly, these levels differ for about 6 reasons. Usually, decisions and actions at a strategic level happen over long periods of time, sometimes years, whereas at an operational level, they can take place over a matter of minutes. Next, the extent to which the company is observed varies at these levels too. At a strategic level, there is a need to have a wide focus or to look at the bigger picture. But this wouldn't help at the operational level, where there is a need to be very focused. The same can also be said for the level of detail that the company needs in terms of reporting. Managers will need high level of information, for example, their daily sales or staff rota, whereas executives would only need highly summarized information as they deal across different departments in the business. This is where an executive information system would come in handy, allowing directors to drill down into queries if need be. The level of certainty also changes between levels. Strategically, the board will be making decisions that will impact 2, 5, or even 10 years down the line. This level of planning will make it difficult to be certain about future outcomes. The opposite is true at an operational, say, a manager placing an order of stock can say with 99% certainty that it will arrive when it's promised. Sources of information and sources of data, or types of info, will also vary between these levels. Strategic information will come from everywhere and be a mix of numbers and facts, and which will be used to make decisions, which will then be fed forward to management. These can come from your accounts, budgets, market research, customer data, trade partners, or journals. Management will usually receive information in the form of quantitative feedback, usually via management accounting from head office. Now that we're comfortable with that, I'd like to talk about an acronym that everyone's heard of, but can't really apply or make sense of, and it's called SWOT. This stands for Strengths, Weaknesses, Opportunities, and Threats, and is a great way to appraise your business. Strengths and weaknesses come in the form of internal focus. Opportunities and threats tend to be external. Strengths and weaknesses. So we could look at this in a variety of different ways, but the four main things are financially, so your ratios. Your strength could be a high profit margin, or weakness could be a low profit margin. People, you could have a high staff turnover, which would be a weakness, or you could have low staff turnover, which would be a strength. A lot of your colleagues or your staff could be trained, or they could be undertrained. This would be the difference between strength and weakness. Your products, like your sales targets, or your quality standards, and your marketing, your market share could also be a form of strength or a weakness. Externally, the biggest opportunities and threats come from competition. So if someone left the market, that would be an opportunity. If someone came into the market, that would be a threat. Politically, there's legislation, so you could undergo, try to enter a new market, and the current manufacturer or the current person serving that market has protectionism in place from the government or receives subsidies in the domestic market. That would be a threat for your business. Similarly, economically, you could be in a boom cycle or a bust cycle, and that would be considered an opportunity or a threat. Another great way to assess your business is to use something called a PEST analysis. And it basically is another acronym which stands for political, economic, social, and technological. These are the 4 factors you really want to assess before entering into any new market or any new product development. So the political analysis would focus on legislation on trading, pricing, dividends, tax, employment, and protectionism. Things that impact your business economically would be taxation levels, inflation rate, increase in rates of unemployment or interest rates or exchange rates, subsidies to the competition. Socially, there could be changing values and lifestyles, beliefs, patterns of work and leisure, changes in ethnicity and religion. And technology, this would be a change in how services are provided or how we identify new markets. Another model that is similar to the pest analysis is a thing called Porter's 5 forces. This examines the 5 forces that affect an organization's ability to make a profit, and basically it is considered the microenvironment for most businesses. This microenvironment is basically your market and how well you can serve your customers. Any change in one of these 5 forces will result in less profit and the need to reassess your marketplace. The 5 forces are threat of new entrants, bargaining power of buyers, the bargaining power of suppliers, and the threat of substitutes. This all comes together to create competitive rivalry within the industry. The threat of new entrants. This depends to the extent to which there are barriers to entry. So if the barriers must be overcome by new entrants in the market, if they're to compete successfully, the existence of barriers should be viewed as delaying entry, not permanently stopping potential entrants. Typical barriers include economies of scale. The capital requirement of some industries is too big for people to enter. Access to supplier distribution channels, supplier and customer loyalty, cost disadvantages independent of scale, expected retaliation, government regulation, and differentiation. The bargaining power of buyers will be high where there are few large players in the market. For example, large supermarket chains can apply a great deal of price pressure on their potential suppliers. This is especially the case where there are a large number of undifferentiated small suppliers, such as small farming businesses supplying fresh produce to large supermarket chains. There will also be large buying power if the buyers are well informed, if the buyers have the potential for backwards integration, if the buyer earns low profits, or if the buyer's product is not significantly affected by the quality of the supplier's product. The bargaining power of suppliers, to put that on a flip, will be high where there are a large number of customers, or the switching costs are high, or the brand is a powerful one like BMW or McDonald's or Microsoft, or there's the possibility of the supplier integrating forward, like a brewery buying up a restaurant or a restaurant buying a brewery, or where the customers are fragmented so that they have little bargaining power, such as the customers of a petrol station situated in a very remote location. The threat of substitutes is higher where there is a product for product substitution. And this means, like for fax and postal services, for example. The threat of substitutes is also high where there is a substitution of need. For example, better quality domestic appliances will reduce the need for maintenance and repair services. The information technology revolution has made a significant impact in this particular area, as it has greatly diminished the need for providers of printing and secretarial services. And competitive rivalry, finally, is going to be high where there are a number of equally balanced competitors of a similar size, or the rate of market growth is slow, or there's a lack of differentiation between competitor offerings, because in such situations, there's little disincentive to switch from one supplier to another. If the industry also has high fixed costs, perhaps as a result of capital intensity, this may precipitate price wars and hence low margins. There are also competitive rivalry when there are high exit barriers. This can lead to excess capacity and consequently increased competition from the firms effectively locked into the particular marketplace. Porter also has another model which is called his generic strategies model, and this is quite interesting because when you're going into a marketplace, you really need to focus or pick one of these three things. It's actually kind of four things, but Porter basically argued that to enter a market, you need to either be a cost leader, so you need to have a product and charge the lowest prices consistently, like think of Aldi or Lidl, or you can do something like differentiation, which is kind of like the Whole Foods or Planet Organic model. It's quite highly priced, but it's quite different to whatever else anyone else is offering in the market. And he argued that anyone stuck in between these two will need to focus on other things because they're not going to make it in the market. So you need to be either focused on everything else or just focus on being a cost leader or a differentiator. And basically that's everything for this episode. Thanks very much. If you like or want to, you can like this video, and if you want to ask a question, please leave it in the comment section below. Thanks.